If I told you that a single diplomatic memo about a waterway in the Middle East sent over the weekend would somehow add trillions of dollars to American technology companies by Monday afternoon, you would probably think I was completely detached from reality.
Oh, absolutely. I mean, it sounds like the setup to a bizarre financial conspiracy theory, honestly.
Yeah.
The distance between, a cargo ship route in the Persian Gulf and a server farm in Silicon Valley seems virtually infinite to most observers.
It really does. And yet, on this Monday, August 3, 2026, that is the exact sequence of events that unfolded.
Yeah, if you looked away from your screen for even a moment today, you missed a historic shift in the financial landscape.
Exactly. So today's deep dive is powered by a really comprehensive post-market research brief tracking Wall Street's closing bell. And our mission for you today is to unpack what we are calling the August ascent.
Right, the August descent. Because we are looking at a trading session where geopolitical shifts triggered an absolute explosion in the stock market.
Yeah, and when we look at the raw data, the sheer scale of the buying pressure across the board was just staggering.
It really was. I mean, it wasn't just a rally in a few favorite sectors. It was a broad, systemic repricing of assets.
Let's get right to the big board to set the stakes for you. The Dow Jones Industrial Average didn't just have a solid session, it surged almost 700 points.
Wow.
Yeah, up 1.32%, landing at a record close of 53,178.03. And the S&P 500 hit a fresh closing record at 7,604.112.
Which is a 1.53% jump, just to put that in perspective. I mean, those numbers alone would be the story of the month in a normal market environment.
Oh, for sure.
But the tech sector took those gains and just magnified them exponentially.
They really did. The Nasdaq led the entire pack, up 1.81% to close at 25,818.69.
Even the smaller companies got in on the action, right?
Yep, the Russell 2000 gained 0.90%, and perhaps the most telling number of all is the VIX.
The fear gauge.
Exactly. For those unfamiliar, the VIX is essentially the market's fear gauge. It measures expected volatility. And today, it cooled off by 3.6%, dropping to 16.13.
So investors just completely shook off the wild panic swings we saw back in July.
They did. So help us make sense of this mechanics. Why did August kick off with such a decisive, overwhelming risk-on explosion?
Well, to understand the architecture of this massive tech rally, we actually have to step away from Wall Street completely for a second.
Wait, really, where are we going?
We have to start with a geopolitical map and the global commodities market, because the primary catalyst for everything you just read off wasn't a sudden technological breakthrough.
Right.
It was a shift in global policy. Specifically, the market is reacting to the Trump pivot.
Okay, so we are talking about the White House headlines that crossed the wire over the weekend.
Exactly. That is the foundation of today's movement. Over the weekend, the White House signaled a major policy shift regarding the Strait of Hormuz.
Right. They indicated a distinct move away from a military posture and toward diplomatic talks.
Yes. And, as impartial observers of the market, we are not evaluating the politics or the ethics of this maneuver. We are solely focused on the sheer economic mechanics of what a de-escalation means for global trade.
Because the Strait of Hormuz is essentially the jugular vein for global oil shipments. I mean, roughly a fifth of the world's daily oil consumption passes through that single narrow waterway.
Right. And the market reaction to this pivot toward diplomacy was instantaneous. Brent Crude plummeted 5.1%, settling at $80.34 per barrel.
I want to pause on that drop because I think it's crucial for you to visualize what that actually means.
Yeah, it's huge.
Think about a sudden 5.1% drop in oil prices, like an instant, massive tax cut for everyday consumers and global businesses.
That's a great way to put it.
Suddenly, the cost to fill a gas tank, the cost to ship cargo across the ocean, the cost to manufacture raw materials, all of it gets cheaper overnight.
Overnight.
Yeah.
Literally.
But I am struggling to square this circle a bit. How does one diplomatic headline from the Middle East instantly recalibrate Wall Street's inflation fears and send the Nasdaq skyrocketing?
Well, it all comes down to how institutional algorithms and bond traders measure future risk. Like you said, oil touches literally everything in the physical economy.
Right.
When oil prices are high, it acts as an embedded energy tax on the consumer. That tax drives up inflation because companies pass those higher shipping and manufacturing costs onto you at the grocery store or, the electronics shop.
Exactly.
When that threat evaporates in a single session, as we saw today with that 5.1% drop, it provides an immediate disinflationary tailwind. The pressure valve is just released.
Meaning investors suddenly aren't terrified that inflation is going to spike and erode the value of their dollars.
All right. And that shift in sentiment instantly repriced the bond market. Because inflation expectations dropped so sharply today, the 10-year Treasury yield retreated from 4.75% on Friday down to 4.68% today.
Okay, I need to unpack that 10-year Treasury yield movement because a drop from 4.75% to 4.68% sounds tiny to anyone outside of finance.
It does sound like nothing, yeah.
It's just 7 basis points. But falling bond yields are the lifeblood of high-growth stocks. Let's walk through the mechanics of that.
Sure. Think of the 10-year yield as gravity for the stock market. Tech companies, especially the giants, are valued based on the massive profits they promise to generate years or even decades down the road.
Right, future cash flows.
Exactly. But money today is always worth more than money tomorrow. When bond yields are high, the mathematical penalty for waiting for those future profits increases. High gravity weighs down their stock price.
But when that yield drops, when gravity weakens, the mathematical penalty for waiting shrinks.
Yes.
So those future earnings are instantly worth more today, making those tech stocks instantly more valuable.
You're hitting on the core mechanism perfectly. And that weakened gravity takes us straight from the geopolitical map directly into the tech sector for this incredible cloud comeback we saw today.
It really is a comeback story. Because if you rewind the tape to late July, the market was suffering from this massive AI hangover.
That was grim.
The narrative was entirely focused on fear. Everyone was talking about alarming CapEx, capital expenditures.
Right.
Investors were sweating over the billions and billions of dollars these tech giants were spending to build out artificial intelligence infrastructure, building data centers, buying chips, cooling those data centers. I mean, it is a cash-burning furnace.
It is. The fear was that these companies were building multi-billion-dollar highways to nowhere.
Wow, yeah.
But with the pressure of high interest rates easing up today, that narrative shifted dramatically. The fear of alarming CapEx suddenly transformed into the excitement of monetization reality.
Monetization reality.
Yes. Investors are looking at fresh data and deciding that these massive investments are finally actually paying off.
And the standouts today were absolute monsters. Alphabet, Google's parent company, spiked 5.3%.
That's a huge move for a company that size.
It is. And the catalyst there was just staggering. They revealed 82% year-over-year growth for Google Cloud.
Sustaining 82% growth for a division of a company that is already that massive defies most traditional business cycle models, honestly.
It does. And then you have Amazon, which jumped 4.1% today.
Yeah.
And by doing so, they officially crossed the historic $3 trillion market capitalization milestone for the very first time.
Just an unbelievable valuation.
And NVIDIA also climbed 3.1% as investors aggressively rotated back into computer chips after a really rocky July.
Right.
But I have to challenge this exuberance for a second.
Okay, go for it.
Last month, these massive AI infrastructure costs were a 5-alarm fire. How does one single Google Cloud report of 82% growth suddenly make everyone forget the billions being burned? Do the costs just not matter anymore?
No, the costs absolutely still matter. Building data centers and training massive language models remains incredibly expensive. The underlying balance sheets haven't miraculously healed overnight.
Right.
But what's happening today is a psychological shift in the market's focal point. The stock market is a forward-looking mechanism. For today, at least, investors are choosing to view those massive AI investments as finally hitting the top line. They're seeing the revenue actually materialize on the ledger.
So the market is looking at Google Cloud and saying, we acknowledge you spent a fortune building this infrastructure, but look at the mountain of cash you're starting to bring in because of it.
That's the exact formula. When you couple that tangible proof of revenue with a drop in borrowing costs, thanks to that falling 10-year yield we discussed earlier, institutional money managers decide the growth story is back on track.
Right.
They're willing to pay a premium for that future growth again.
Okay, so what does this all mean for the broader market? Because a rising tide didn't actually lift all boats today.
No, it certainly didn't.
The exact phenomenon that caused the broader market to rally the falling oil prices absolutely crushed some specific sectors.
Right, it's like a seesaw.
Exactly. It's like adjusting a massive thermostat for the global economy. Turning down the heat, meaning the price of oil, makes the environment perfect for tech companies to run their servers and expand cheaply, but it absolutely freezes the profit margins of the companies selling the fuel.
That thermostat analogy perfectly captures the internal rotation we saw today. The energy sector, tracked by the XLE ETF, was the clear outlier.
Yeah, they took a hit.
It dropped 2.4%. We saw global titans like ExxonMobil and Chevron facing heavy, sustained selling pressure throughout the session.
Because that geopolitical fear of oil spiking to $100 a barrel simply evaporated.
Exactly. When the geopolitical premium on oil disappears, analysts have to immediately adjust their spreadsheets. The projected profits for those energy majors get slashed for the upcoming quarters.
Right.
And then institutional investors reallocate their capital into sectors with better growth profiles like tech. It is a ruthless, highly efficient reallocation of capital.
But energy wasn't the only drag on the market today. We need to examine Apple.
Yeah, Apple's an interesting case today.
They completely missed the tech party, dropping 1.9%. The sources point to them continuing to suffer from what analysts are calling guidance fatigue, following their earnings report last week.
Right, guidance fatigue.
I want to explore that term, guidance fatigue. Does this mean investors are just tired of hearing a CEO be cautious? What does that signal about the health of the everyday consumer?
Well, guidance fatigue is a really fascinating psychological phenomenon in markets. Management teams usually issue forward guidance, which are predictions of their future sales.
Sure.
When a company repeatedly issues cautious, uninspiring, forward-looking statements quarter after quarter, investors grow fatigued. They just stop giving the company the benefit of the doubt.
Okay.
And Apple serves as a critical bellwether for the global economy because their products are everywhere.
So the market is trying to deduce if Apple's caution is a symptom of a larger disease.
Exactly the puzzle analysts are trying to solve right now. When Apple shows caution, you have to ask if they are seeing a tapped-out consumer. Is the average person struggling with inflation and holding off on buying a new iPhone?
Right. Or conversely, is this simply a gap in Apple's own specific product cycle?
Exactly. For today, they acted as a minor anchor on the tech-heavy indexes, proving that even on a record-breaking day, you can't just buy a tech index blindfolded and expect everything to go up.
You really can't. But while Apple dragged, we also had an incredible outlier on the positive side that had absolutely nothing to do with AI or oil.
Oh, yeah.
Bristol-Myers Squibb defied all the broader trends and surged a massive 9.8%.
That surge was driven by verified reports crossing the wire that AstraZeneca is actively exploring a mega merger with them.
A near 10% jump on a pharmaceutical giant of that size is wild.
It really is.
It illustrates a great lesson about markets. While macro trends like oil prices and interest rates dictate the weather for the broader index, single stock catalysts like the rumor of a mega merger can still create massive, localized shockwaves that ignore the weather entirely.
That's spot on. And that concept of localized shockwaves leads us perfectly into what happens after the closing bell rings. Because the 4:00 p.m. bell in New York is merely a pause in the action.
Oh, absolutely. The true health of the economy is actually being tested right now as we speak in after-hours earnings and incoming macroeconomic data. The data-intensive side of the economy is crossing the wire.
So what are we seeing?
Let's look at what's happening. We have V2X, Inc. up 4.2% in after-hours trading. They delivered a classic beat and raise.
Okay, those are always well received.
Revenue came in at $1.26 billion, beating the $1.21 billion estimate. And earnings per share hit $1.64 versus the $1.52 expected.
The raised part of that equation is the crucial element, though.
Right.
Management raised their full-year 2026 guidance, and they explicitly cited robust national security demand, which ironically ties right back to the geopolitical tensions we started this deep dive with.
Wow, it really does.
Even as tensions ease in the Strait of Hormuz, the structural demand for defense and security tech remains incredibly potent.
Everything is connected in this ecosystem. Meanwhile, Vertex Pharmaceuticals is trading flat after hours. It's a deeply mixed bag.
How so?
Their cystic fibrosis revenue remains an absolute fortress, incredibly strong and reliable. But the market is sitting on its hands waiting for more clarity on the commercial rollout of their VX-548 pain management drug.
See, investors despise uncertainty above almost everything else.
Yeah.
Even with a company generating strong core revenues, a lack of clarity on how they will monetize a major new pipeline product will keep a stock completely anchored.
Right.
They need to see the roadmap.
Speaking of needing to see the roadmap, we have some highly anticipated reports still pending that have options traders totally on edge.
Oh, yes.
Palantir is about to report, and the market has priced in an implied move of plus or minus 11.4%.
That is massive.
Let's clarify that for a moment. An implied move is essentially what options traders are predicting the stock will do, based on the cost of buying insurance puts and calls on that stock. An 11.4% move in either direction is massive volatility.
It shows the immense stakes for this single earnings call. The key metric everyone is laser focused on is their U.S. commercial AI platform revenue.
Right.
Our sources indicate that anything under 60% growth in that specific division might be severely punished, despite the massive tech rally we saw across the board today.
That shows you just how high the bar has been set for AI monetization. You can no longer just put out a press release saying, hey, we do AI.
No, those days are over.
You have to prove you are growing revenue by over 60% just to keep investors from dumping your stock.
Exactly.
We are also watching on Semiconductor, which is reporting shortly. They have an implied move of plus or minus 12.4%.
Also huge.
Because they are the undisputed leader in silicon carbide technology, their forward guidance is going to dictate the tone for the entire electric vehicle supply chain tomorrow morning.
So with all this micro-level corporate data swirling around the macro-level geopolitical shifts, it sets up a fascinating, high-stakes tug-of-war between the bulls and the bears on Wall Street.
Let's break down that macro debate because this is where the philosophy of the market really shines.
Okay.
The bull case is that we are in a perfect Goldilocks rotation. Oil is down, which lowers inflation. AI investments are finally proving to be profitable, driving growth.
Right.
And the Federal Reserve is happily sitting on hold, keeping interest rates steady at 3.50% to 3.75%. Everything is, like the fairy tale, just right.
It is an incredibly compelling narrative for the optimists, and the price action today certainly supports it.
But the bears are looking at the exact same market landscape, the exact same data points, and drawing a very different, much darker conclusion.
They always do.
The bear case is that today wasn't a structural lasting shift. It was simply a temporary relief rally. And their main piece of evidence is the ISM Manufacturing Index, which was released earlier today.
Right, the manufacturing data.
It came in showing unexpected strength at 55.6. Any number over 50 indicates expansion. But I need to stop here because this is the most baffling part of modern finance.
It really is.
If the ISM Manufacturing Index is showing strength at 55.6, meaning factories are busy and the economy is expanding, isn't a strong economy a good thing? Why are the bears using good economic news as a weapon to say the market will fall?
Well, welcome to the twisted counterintuitive logic of Wall Street in an inflation-wary era. To understand this paradox, you have to remember the primary overarching mandate of the Federal Reserve right now.
Okay.
They are terrified of a second wave of inflation.
So they are actively trying to slow the economy down.
Yes, they want the economy to cool down just enough to ensure inflation is dead and buried without triggering a massive recession.
Right.
If manufacturing is booming, if factories are hiring, and the economy is running quote-unquote too hot, the Federal Reserve might look at that 55.6 ISM number and say, we cannot afford to cut interest rates yet.
Oh, I see.
There is too much money chasing too few goods, and things are still too heated.
I see the mechanism now. Good news for the factory floor, more jobs, more production, is actually bad news for the stock portfolio.
Exactly.
Because a hot factory floor means the Fed keeps interest rates high, which keeps the mathematical penalty on tech stocks high.
You got it. It feeds directly into the narrative that the Fed will be forced to keep interest rates higher for longer. And this is the core reason why the bears are warning everyone not to get too comfortable with today's record highs.
Because the relief from the oil drop could be entirely temporary.
Yes, all eyes are now firmly fixed on Friday's upcoming non-farm payrolls report, the NFP.
Because if that jobs report comes in too hot,
if Friday's report comes in showing massive, unexpected job growth, it could completely undo today's entire rally. The market will panic, assuming the Fed is going to keep borrowing costs elevated, and the decreased gravity we saw today will just vanish.
the tech sector would be pulled right back down to earth.
Instantly.
It is astonishing how precarious it all is. To quickly summarize this incredible journey we've been on today, we started halfway across the world with a diplomatic policy pivot in the Strait of Hormuz.
Right.
We watched that geopolitical shift cause global oil prices to tumble. That drop in energy costs acted as a tax cut, easing inflation fears, which caused the 10-year Treasury yield to drop.
And then gravity weakened.
Exactly. That drop in borrowing costs weakened the gravity on valuations, igniting the tech sector, leading to Google's massive cloud numbers being celebrated, Amazon joining the elite $3 trillion club, and ultimately the Dow jumping nearly 700 points to a record high.
It serves as a perfect example of how hyper-interconnected the modern global economy truly is. A single diplomatic thread pulled in the Middle East weaves its way entirely through the fabric of Wall Street's algorithms within a matter of hours.
Which brings me back to you, the listener. After hearing how all these complex dominoes fell today, which part of this August descent do you think is built to last and which part is just a mirage?
That's the million-dollar question.
Is the AI revenue we are seeing real, sustainable growth? Or is the manufacturing data going to force the Fed's hand and pull the rug out from under us on Friday?
And if you circle back to where we started, looking at the market like a predictable mathematical machine, well, I will leave you with this final thought to ponder.
Go ahead.
If a single weekend pivot in global diplomacy can instantly erase a month-long AI hangover and add trillions of dollars to tech market caps in a matter of hours, how fragile is this new monetization reality?
Yeah, it's a great point.
Are we truly trading on the fundamentals of technological innovation, or are these record highs entirely at the mercy of the very next geopolitical headline to cross the wire?
A brilliant and honestly slightly terrifying question to end on. Thank you for joining us for this deep dive into a truly historic day on the markets.
Thanks for exploring the underlying mechanics with us. Keep questioning the consensus.